Vivek came to meet his friend Bhaskar, who's very good at reading charts. But that day, he was very stressed. Vivek asked him, "What's the matter?" Bhaskar replied that the market is not in good condition and it has corrected a lot. Vivek asked what was special about that day as market has been falling for the last 8 days. Bhaskar replied that the market has breached the 200 DMA. "What is 200 DMA?" asked a confused Vivek. To which Bhaskar explained that DMA means daily moving average. So 200 DMA means moving average for the last 200 days. This is a long-term average. If this level is breached, then it indicates that market can fall a lot more. Moving average is a good way to assess trend and momentum in the market. It is a simple technical analysis tool. It gives you an updated average price. It simplifies the data in the market. Moving average has a fixed time frame like 5 days, 10 days, 50 days, 100 days or 200 days. There can also be a fixed time frame of 1 week.
Vivek understood about moving averages, but how will it help stock market players? Basically, moving averages will help you in understanding trend. It helps both short-term traders and long-term investors. That's because it can be set for any time frame.
Moving average gives a basic idea about where the market is going. It is generally used to look at the trend of a stock or an index. Besides this, it also helps in looking at support and resistance levels. Moving average is known as a lagging indicator. It's because it reacts to the events that have already occurred. Basically, there are various kinds of moving averages, but simple moving average and exponential moving average are the most common ones. For example, to calculate 10-day simple moving average, look at the daily closing price of the last 10 days, sum them and divide it by 10, which is the number of days. This way, we can find simple moving average for any number of days. On the other hand, calculation of exponential moving average is a little complicated. In this, weightage is given to all the days for calculation. Hence, the calculation of the exponential moving average is usually done on some software or trading platform. Vivek has understood about how to look at trend from the daily moving average and also that they are mainly of two types. But he was confused as to which one would be better for him between the two of them, that is simple moving average and exponential moving average. Now Vivek got very curious about moving averages. Now he wanted to know how moving averages are used.
When the price of a security or asset is below or above the moving average, then it's indicator for technical traders to trade. That's why it is most commonly used to understand market direction, support and resistance levels. The most popular way to look at moving averages is to compare it with the price of share or index. When the price of a security goes above moving average, then it is an indication to buy. Similarly, when a price of a security goes below moving average, then it's an indication to sell. Many traders make their entry or exit strategy based on this. But the question is, how moving averages can tell you about trend reversal or the change in trend? Two types of moving averages crossovers are very famous. One is golden crossover and the second one is death crossover. When 50-day moving average intercepts 200-day moving average from down, then the analysts consider it as a big indicator or bull rally. Analysts call this golden crossover. When 50-day moving average intercepts 200-day moving average from above, then the analysts consider this as a big indicator or a bear rally. Analysts call this the death crossover. Vivek tells Bhaskar that he has told about all the positives, but what about the negatives or the limitations of moving averages? Now you must have understood about what is moving average, what are its benefits, how it is used and why Bhaskar was concerned about the market. So if you're a trader or investor, then understanding about moving averages will help you in making entry and exit strategies.